Good morning to all. Welcome to my channel. Today we will be discussing another important concept, that is capital budgeting decision under your financial management curriculum in MBA. What is investment decision? Investment decision means you can invest your current money for long-term benefit. So this investment decision in other way can be called as capital budgeting decision. So when this investment decision or the capital budgeting decision, by name itself, it is very much clear that this will be for future rate of growth concept. So for that purpose, you are to be very cautious and careful selection of your project, because when you are investing a large sum of money and you do not know what will happen in future, so that's why you are to be very carefully select the project. Once you invest the money, you cannot go back, because this is a for 4 years, 5 years, so maximum 10 years cases. So you have to wait for the result. Now we will be discussing what are the points of investment decision. So when you are long-term investment, always the risk factor is there. So that risk analysis you have to make in advance. That is, you may have to what type of investment you have to do it, which project you have to do it. Lots of market research you will have to do before making any investment. So these are the basic conditions for that. Now, how to evaluate the criteria of any project in financial terms. So under financial management, there are two types of evaluation criteria. Broadly, one is discounted cash flow criteria, another is non-discounted cash flow criteria. See, by name calls this discounted cash flow means you are to evaluate the future value of money. Suppose today 10 rupees and receiving after 5 years 10 rupees may not be the same. So expected cash flow over a period of time, you have to discount it so that you will be knowing that real time value of money will be taken into consideration. So first concept is the net present value. Net present value means what are the incomes or your expected incomes will be there or receipts will be there, that will be converted in the present value form. So that will call the net present value of your future cash flows. Rather, whatever the future cash flows, you have to discount it so that you will be getting the net present value concept. Another discounted concept is the internal rate of return. So this internal rate of return also is called the marginal efficiency of capital or rate of retention of cost of capital, rate of return over cost, time adjusted internal rate of return. IRR is the matching rate between what is your expected rate is there. So that is the internal rate, is nothing but the matching rate. Another, your profitability index, that is also another method. So how to calculate that profitability index? Profitability index, you can calculate your total present value of cash inflows divided by initial cash outlay. How much cash inflows are coming, here also you have to calculate their present value, and sum total will be divided by the initial cash outlay. So this index also will be a determinant for your investment decision analysis. So these three things what we have discussed, that is net present value, internal rate of return and profitability index, all are discounted cash flows. When we will be talking about the non-discounted cash flows, that means money as it is, one that traditional concept is the payback period. So payback period is nothing but the future cash flows are to how many years it will be required to your total initial investment from the cash flows. So that means total cash flows by your capital investment, that is the number of years you will get your total payback period. Payback period is nothing but the paying back your total investment in the number of years from the future cash flows. So this is called the very traditional concept, payback period. Another is the discounted payback, same concept of payback period, but here also the time value of money is being considered here. So that's why here it is a discounted cash flow they are taking into consideration. Another is accounting rate of return. That is also another method of your this evaluation criteria. So what is that accounting rate of return? Accounting rate of return is the return on investment. Accounting rate of return is also a return on investment using accounting information. Accounting also known as the return on investment. So you can compare the net present value and internal rate of return. So these are the things. So now question comes, whatever methods you calculate your project acceptability, you are to judicial decisions you take it, because these are all the long-term investments and you cannot go back. That's why you will have to select your proposal taking into consideration all the very angles of the issue. So if you, this is the a preliminary discussion on that. So now will be one evaluation criteria. In my next video I will be discussing individual headwise. This is the basic idea for your that capital budgeting decision. What is capitalization? All this we have discussed. If you think that my this video some material is there, and if you consider that it will be helpful and beneficial to you, you can like it, share it, and the subscribe for this channel, so that in future I will be making some more videos for your other subjects of your MBA curriculum, financial management, as well as other areas of financial management. Today we are ending this video. Have a good day.